we are going to continue on with this concept and talk about inventory accounting. We're going to look at how we calculate inventory under perpetual inventory system. And instead of keeping track of all of our cost, we're going to use some methods of estimating our ending inventory. We know accrual accounting. We keep talking about that in this class, but it's basically matching income when we earned it against costs when we incurred it. And so with this chapter relating to inventory, that accrual method still holds true. And the valuation is, because so much can go into inventory, we're going to try to find a way to estimate as accurately as possible the valuation of what's sitting in ending inventory and yet what we show in our cost of goods sold. Inventory, what's left on the shelves at the end of the period, is a current asset, because generally we want to sell our inventory in that current operating cycle. For a merchandising company, inventory consists of goods owned and goods held for sale in the course of a business. So for Target, the inventory is going to consist of all the products sitting on the shelves and back in the warehouse that are available to be sold. Manufacturing companies, it gets a little more complicated. Manufacturing companies have three types of inventory. Think about making these desks or these tables. They have to go and purchase wood and purchase the laminate and purchase some of the metal and purchase paint. Those items are considered raw materials. It's the goods they have to go out and purchase to make the product. Then in the assembly lines, they have to take all these various raw materials, pull them from the raw materials inventory, and utilize those pieces as they're making the desks. Okay? While they're making the desks, that portion of inventory is called work in process. Partially completed products. Once a desk is totally completed, it goes into an aspect of inventory called finished goods. Those finished goods are ready to be sold. So with manufacturing companies, instead of just going out like a Target and buying the end goods to sell, manufacturing companies make those goods. So they purchase the materials to make the goods. They have goods that are, while they're creating them, the work in process. And then they have the finished goods that are all complete and ready to be sold. The work in process and the finished goods each have three components. Cost of the raw materials that go into the product, the cost of the labor used to convert the raw materials to the finished goods, and overhead costs that support the production process. The overhead costs are costs of indirect materials. So it might not be the actual wood and the laminate. It may be things that help accommodate those materials, such as packing products. Indirect labor, such as the supervisors who oversee the work. They're not necessarily right on the production line, like direct labor, but they still are part of the whole process. And factory rent, depreciation of plant assets, and the utilities in the plant. So overhead costs can sometimes amount to a lot of money, even though it's a big lump bucket that items that aren't directly related to the materials get put into. For those of you who are going on in accounting, you're going to have 2 cost accounting classes that primarily focus on all of this. So we're going to cover it very general because you're going to have 8 credit hours of just dealing with cost accounting. Okay? The primary objective of inventory accounting is to apply the accrual accounting to determine the cost of inventory sold during the period. When we value items, we generally do it at what we paid for it, or cost. Inventory costs include what we pay for something, the invoice price less any discounts, any freight that we have to pay to get it there, any taxes, sales tax or tariffs, all the costs to get those materials to the location are all included in inventory. Inventory valuation depends on the prices of goods, which vary during the year. It'd be easy if our raw wood cost the same in January as it does in April as it does in December, but it doesn't always do that. Especially when we're dealing with commodities, they go up and down based on the economy. Gas. This is a great example just with gas. Have you guys noticed how the gas prices have just jumped up? They were like $2.12, a month ago. Now they're up at like $2.39. So can you see when you're working with companies and gas is a part of the cost of creating their product, how it can fluctuate and vary throughout the year. A company may have purchased identical lots of merchandise at different prices. Sometimes it's tough to tell which have been sold and which products are still in inventory. So we have to sometimes assume certain aspects to come up with the appropriate valuations and what's been sold, what's still available. Which of those products did we sell or did we use in our cost of goods sold, and what was the cost of them? It can get complicated. Because the assumed order of sale may or may not be the same as the actual order of sale, this assumption is already about the flow of cost rather than the flow of physical inventory. So we care more about the cost of things. Not necessarily did we use the latest piece of wood or the earliest piece of wood, as we care about the cost of that wood. Okay? Goods flow refer to the actual physical measurement of goods in the operations of a company. But cost flows refer to the association of costs with their assumed flows. So goods are, did the last good that got purchased is the first good we use, or is the oldest piece of wood the piece of wood we're using? That's all related to goods flow. We don't care so much about goods flow in accounting as we do about cost flows. Is the oldest piece of wood that we paid $3 a square foot for what we're going to show to be what was used in our cost of goods sold, or is that still sitting in our ending inventory? We care more about cost flow than we do goods flow. The assumed cost flow may or may not be the same as the actual goods flow. Sometimes it's preferable to use an assumed cost flow that doesn't bear any relationship to the goods that we used, because we might get better results of how our income really looks. Since merchandise inventory includes all items a company owns and holds for sale, the status of any merchandise in transit, whether the company is buying it or selling it, has to be looked at to see if it needs to be included in our inventory count. Think of this. When we have purchased some merchandise inventory, but we have to pay for shipping, when does title pass? Title usually passes when we get the goods for shipping. If we are purchasing merchandise inventory but the seller pays the cost of freight, we don't gain title to those goods until it hits our warehouse. So it's important for us to keep track of what products out there do we own that we have title to because we own them, and what goods out there do we not have title to because we don't own them yet based on the shipping. The same is true when we sell goods. Who's paying the shipping will determine when the title transfers to the buyer, the new buyer. Here's an example of merchandise in transit. We purchased goods from a seller's warehouse. The goods are being shipped to our nice boutique. If the terms are FOB shipping point, then at this location right here, the buyer owns the inventory. FOB shipping point means the buyer pays the shipping. If FOB destination is the means of shipping, then that means the seller pays for the shipping until it hits the boutique. So goods that are in transit, if it's FOB shipping point, that means the buyer owns those goods. If it's FOB destination, that means we don't own these goods while they're being shipped because we only transfer title when they hit our boutique. Does that make sense?
So the shipping point, we own them at the warehouse.
Correct.
And we also pay for the shipping.
Correct. Outgoing goods shipped FOB destination are included in the seller's merchandise inventory, whereas those shipped FOB shipping point are not. Incoming goods shipped FOB shipping point get included in the buyer's merchandise inventory, but those shipped FOB destination do not. At a time a company takes a physical inventory, it may have merchandise in which it does not hold title. Examples, goods we've sold but we haven't delivered yet. We're still going to have title to those goods. They're sitting in our warehouse. We haven't delivered them yet. There are also companies that have goods on consignment, which means the merchandise that's in the store is in the store, but we don't truly own that merchandise. We're just renting space to try to sell it. Goods to which the company does not hold title should not be included in its physical inventory. I'm not going to worry about that. So, management has to make a couple choices in determining how they account for inventory. There's two methods in accounting for inventory, the periodic method and the perpetual method. We kind of went over it in the previous chapter. Then there's another thing we have to look at is the inventory costing method. Are we going to cost that inventory based on specific identification? Are we going to take an average cost of all of the goods? Are we going to use what we call Lifo, where the first goods that we paid for are the first goods we sell? Or are we going to use something called Lifo? The last goods we paid for are the first goods we sell. We've got to figure out which method are we going to use. And then we have to create what's called a valuation method. We generally show valuation at what we paid for an item. But if the market value is lower than what we paid for an item, we have to use what we call lower of cost or market, or LCM, lower of cost or market. We'll go over some problems. So we basically need these three items to determine what was sold during the period and what's sitting in our ending inventory. So, FIFO versus LIFO doesn't have to do with the flow of goods. It has to do with the flow of costs. So what I want to do is, here's a good example. This company, Boiling Company, has started the month with inventory 160 units at $10. Then on April 6th, they purchased 440 units, but they had to pay $12.50 per unit. Then on April 25th, they purchased another 400 units at $14 a unit. So they have available 1,000 units at a total cost of $12,700. But do you see how some units were at $10? Some units are at $12.50. Other units are at $14. So if we sold 560 units and we have left at the end of the month 440 units, which of these units did we sell? Maybe. Each company gets to determine that. Okay? So that's what we're going to learn about, is how we determine which cost do we assign to the ending inventory and which cost do we assign to the cost of goods sold. So what I want to do, I want to go to the book, and chapter 7, I want to look at E4A. Okay, so E4A shows us, page 291, E4A, in chronological order, the inventory, purchases, and sales of a single product for a recent month are shown. We're going to use the periodic inventory system, and we're going to compute the cost of ending inventory, the costs of goods sold, and the gross margin. We're going to use all the methods, the average method, the FIFO, the Lifo methods. So what we're going to do here, we see with E4A, we started with beginning inventory of 150 units. On June 4th, we purchased 400 units. On June 12th, we purchased 800 units. On June 16th, we sold 1,300 units. And on June 24th, we purchased 300 units. So, what we're going to do is look at the various methods. What I'm going to do here is We're going to start with sales. And we can tell, if you look at the book, we had a sale on June 16th of $1,300, didn't we? And we can tell we sold it for 60 bucks, right? So the first thing we're going to do here is we're going to show, this is the number of units. This is the cost. Okay? So we sold 1,300 units at 60 bucks, and so, whoops, doesn't like my equal sign. I'm just going to type in equals. Okay? So we can do 1,300 units times 60. We sold $78,000 worth of product. Okay? This is the sales portion here. Okay? Now what we want to do is we're going to take the book, and we're going to start with our beginning inventory. We had 150 units at, the cost was 30 bucks a unit, didn't we? Here, 150 units at 30 bucks a unit. So I'm just going to create so we know what everything is. 150 units at 30 bucks a unit is 4,500. Then our purchases, we had 400 units at 33 bucks a unit. We also had 800 units at 36 bucks a unit. Then we had 300 units at 39 bucks a unit. So what I'm doing here is showing everything that we have on hand here. These items in here are really showing what we started with, what we purchased throughout the period of time. Okay? So, we have how many units here? 1,650 units, and the cost of all those units are $58,200. Does that make sense so far? The first method we're going to look at relates to what we call the average cost method. Okay? The way we're going to calculate the average cost is we're going to take everything on hand, all 1,650 units, times what it cost for us to purchase those 1,650 units, and we're going to come up with an average cost. So here, what we can do is, if we take $58,200 divided by 1,650 units, we come up with $35.27 an average cost per unit. Does that sound right? So if we create under the periodic system, an income statement by average cost method, we're going to have sales of $78,000. We're going to have cost of goods sold because we sold 1,300 units, right? So our cost of goods sold, but using the periodic method, means what we have to do is show cost of goods available for sale, which is our $58,200, okay? Whoops. Then what we do is figure out what's sitting in our ending inventory. Less ending inventory. If we had 1,650 units available but we sold 1,300, what's in our ending inventory? 300. So our ending inventory will be 300 units times $35.27 a unit, right? Or it would be 350 times 35.27, or $12,345, right? Right? Does that make sense? So our cost of goods sold then is going to be the difference between all of our goods available for sale minus our ending inventory, or $45,856. Therefore, our gross margin is going to be the difference, or our sales minus our cost of goods sold give us our gross margin of $32,145. Does that make sense? So the way we handled this average cost method is we know our sales price is what we get paid for it. We knew everything that we paid for the goods, but the way we determine what is sitting on hand at the end of the period is taking all the cost and averaging them. So we take all of our cost of $58,200 divided by our total number of units of 1,650. We come up with $35.27. If we know we have on hand 350 units at $35.27, we know what our ending inventory is, so we know what we sold. Now, using this method, guys, if we know we sold 1,300 units at $35.27, won't we still get $45,856? Does that make sense? Because everything's getting averaged. So this method allows us to see how we price our inventory based on using an average method, taking what we started the period with plus all of our purchases, and we total them, we come up with an average, and that's what we apply to the ending inventory. Now, so this is the average method using the periodic average method. Now, let's look at using the periodic inventory method using what we call Lifo. Lifo means the last costs that came in are the first costs we sell. Okay? So this concept, I'm just cutting and pasting this so I don't have to type it all again. But this is going to change. So Lifo, let's talk about this. We do know that using Lifo, our cost of goods available for sale is going to be the same. It's $58,200, isn't it? See from up here? $58,200. It's going to stay the same. Actually, I'm going to just get rid of this so I can. $58,200 are our costs available for sale. But what we need to figure out is, using Lifo, what is our ending inventory? We know we have 350 units still available, don't we? So if, wait, I was supposed to do FIFO next, and I'm doing Lifo. Okay, let me do FIFO, okay? FIFO. FIFO means the first products we bought are the first products that go out. Okay? So if you think about it, if we sold 1,300 units, okay? Didn't we sell 1,300 units? If the FIFO means the first ones in are the first ones out. The first ones that we have in here are the first ones we sell. So these 1,300 units means we sold all of this 150, all of this 400, which is 550 now, right? And now we have 750 of this unit we sold, which means what's left on hand at the end of the period, it's going to be 50 of this at 36 bucks and 300 of these at 39 bucks, right? So under FIFO, our ending inventory is going to have 50 units at 36 bucks, or how much is that? Here, I'll equal 50. 1,800, and it has 300 units at 39 bucks, or 11,700. So our ending inventory is $13,500, isn't it? So if that's $13,500, our cost of goods sold is everything else, or $44,700, which means our gross margin is going to be the difference, $33,300. That make sense? All we're doing here is deciding which of these goods did we sell and which of these goods are still sitting in ending inventory. So using the FIFO method, the first ones in are the first ones we sell, which means what's at the end of the month is what's still sitting on hand. Does that make sense? Any questions on that? Now let's do it using Lifo. Lifo means that the last goods on hand are the first goods we sell. So if we sold 1,300 goods, units, does that mean we sold all 300 of these? We sold all 800 of these, And how many of these did we sell? 200. So doesn't that mean our ending inventory using Lifo's ending inventory, wouldn't that mean we have 150 units at $30 a unit, or $4,500, and we have 200 units at $33 a unit, or 13, gosh, what's 13,000, okay, equal 13,200 divided by 2, I'm sorry, what is it? 60, 6,600. So our ending inventory should be 11,100, which means our cost of goods sold is the difference, and our gross margin is going to be our sales minus our cost of goods sold, our 30,900. Do you see that based on the method we use, we're going to get different results? Your first result using the average method was a gross margin of how much? 32,135. What about using FIFO? What is it?
33,300.
And what about LIFO?
3,900.
Do you see how they're all different, but the average is in between? By doing the average, we're taking the highs and the lows and averaging them out.
I have a question for the Lifo one. Why would you do the count the $300 purchase when it's after the sale date?
Good question, because this is not perpetual. This is periodic. So remember, we don't keep track that it really wasn't here anyway.
Okay.
Under perpetual, we would.
Yeah.
Very good question.
What was so confused? We use for the 300 purchase on a 24, we use it in the
calculation.
1,300.
But the 1,300 got sold when?
Got sale before the other one was purchased.
Got purchased. But under this method, we don't care because we don't keep track of it.
Do people, do a lot of businesses use this method? Or is it a certain kind of method?
LIFO, if you look at large companies, they generally use FIFO.
Oh.
Generally, FIFO is used for most companies. The reason people would use LIFO is because if they want their income taxes lower, their net income lower, generally prices do this, they go up. So if you want to have less income, you're going to want to show in cost of goods sold the higher cost.
Yeah. Okay.
But most companies do use FIFO, and the companies are required to disclose it on their financial statements of what they use, and they cannot change it. If they change it, they have to have a reason and they have to disclose it. Because once you begin a method, you have to continue with that method unless you have a reason to change it. Because, again, it's important to be able to compare one year to the next. If you go from FIFO to LIFO, your numbers aren't going to make any sense. Consistency is the key to compare it. Does that make sense? So do you see how under one method you have a lower net income or gross margin than you do under another method? It will all even out eventually. But from year to year you need to stay consistent. The average method is going to keep things pretty smooth sailing along for everybody. Okay? Does that make sense? Now, let's look at E5A. How are you guys doing so far? our job here, Mills Inc. sold 120,000 cases of glue at $20 per case during 2014. Its beginning inventory consisted of 20,000 cases at a cost of $12 per case. During 2014, it purchased 60,000 cases at $14 per case, and later 50,000 cases at $15 per case. Operating expenses were $550,000, and the applicable income tax rate was 30%. Using the periodic inventory system, compute net income using the FIFO method and the Lifo method for costing inventory. Which alternative produces the larger cash flow? So what we're going to do here, I'm going to go back. Let's set this up. I'm going to have a category for FIFO and Lifo. Okay? Okay. Sales, no matter which method we use, are going to stay the same. What were our sales? How many units were sold? 120 at $20. And so 120,000 at $20 is what? 240,000. That's going to be the same either way, right? Yep. 240,000. Okay? Now, how do we determine cost of goods sold? We start with our beginning inventory, don't we? Our beginning inventory, 20,000 units at $12 a unit, right? Right? Yep. Which is 240,000. Then we had purchases of 60,000 units at $14, which was 840,000. We had 50,000 units at $15, which is 750,000. We had 10,000 units at $15, which was 150,000. So our goods available for sale is the same. Our goods available for sale, are 1,980,000, aren't they? But under FIFO, our ending inventory is going to be different than under Lifo. We sold 120,000 units. We had available 20, 80, 90, 140,000 units. What does that mean our ending inventory is? If we sold 120,000 units, but our beginning inventory plus all of our purchases are 140,000 units, but we sold 120, what's on hand at the end of the year? 20, right? We started the year with 20,000 units. We purchased 60,000, 50,000, and 10,000. How much does that total? 140, right? 20 plus 60 is 80, plus 50 is 130, plus 10 is 140. If we sold 120, what do we have to have left? 20,000. So our 20,000 using FIFO. FIFO means the first ones in are the first ones we sell. So our ending inventory would be the last ones in there, right? So FIFO would mean we have 20,000 units at how much cost? $15, right? Do you see how these last units here, this 10,000 was purchased at 15, this 50,000 was purchased at 15? So that means using FIFO, the first ones in are the first ones we sell. So our ending inventory is going to be these last ones. So 20,000 units at $15 means our ending inventory using FIFO would be 300,000. Okay? Does that make sense? Cost of goods sold using FIFO would mean that our sales minus our ending inventory gives us our cost of goods sold. I'm doing something wrong. Oh, cost of goods sold. That would equal our goods available for sale of 1,980,000 minus our ending inventory, or 1,680,000, right? Our gross margin is our sales minus our cost of goods sold, or 720,000, right? Sales minus our cost of goods sold give us our gross margin. Okay? That makes sense?
Yep.
Now let's take this using, instead of FIFO, let's do Lifo. Under Lifo, the last ones in are the first ones we sell. So if we do Lifo, which ones are sitting in ending inventory? 20,000 at $12, right? Or 240,000 So our cost of goods sold are going to be our goods available for sale minus our ending inventory, or cost of goods sold of 1,740,000. Our gross margin will be our sales minus our cost of goods sold, or gross margin of 660,000. Now our operating expenses are going to be the same no matter which method we use. Income before income taxes. Income taxes at 30% would be net income. Do you see how using Lifo versus using FIFO? Our net income using Lifo is $77,000, where our net income using FIFO is $119,000. Because using Lifo, we took the more expensive goods and showed that we sold them. Using FIFO, we took the cheaper goods and showed we sold those. Right? Does that make sense, guys? So, when you go and do problem 2, you're basically going to be doing this. Okay? You're going to basically, based on the periodic method, compute the cost of goods sold for those methods. Compute the cost of ending inventory for wood for fun on April 30th and May 31st using the average cost method. In addition, determine cost of goods sold for April and May. Compute the cost of ending inventory on April 30th and May 31st using FIFO. And then you're going to do it using Lifo. I am going to create a lecture for you, just in case you get overwhelmed. You can walk through it with me, okay? Any questions on this? How are you guys